Hey everyone, welcome to Smart Investing. So this video is going to be about the 5 stocks that Wall Street actually likes for 2023. I'm sure these stocks are not gonna last throughout the whole year. That's just my guess. But as for 2023, let's just go with the first quarter because obviously things change from quarter to quarter. So I'm more certain that these stocks are good up to 3 months. That's my take on it, the way I'm understanding it. So I guess I can say that these are going to be the most favorite stocks from Wall Street, the top five. And I just want to see why they like these companies, if they're any good, fundamentally or technically or strategy wise. It just became a notification a few weeks ago. I've been meaning to look into these companies. I'm not just gonna blindly follow and say, okay, add them to the watch list because that's not what I do. I like to investigate a little bit more and see why and how these companies are managing and just do an evaluation pretty much on it. So these are the 5 stocks that I have. So starting with the one at the bottom, SPGI, TRGP, VICI, Company J, and BIO. So we're going to look into these 5 companies, see if they're any good, then add them to the watch list. Uh, Even if they don't get added to the watch list, we still want to see uh, if there's any relative movement on price. And I just want to see if this is going to actually work going into 2023. So again, first quarter, these are the 5 stocks that are supposedly um, are going to do well, probably for the first quarter. So first one up is SPGI. So we have here this company is at $350.34. This is pretty expensive. I do like expensive stocks, and I would say this would be at the highest range, maybe up to 400. That's usually the max. If it's more than that, then they will have to add companies that are way, way cheaper, like at least, under $100 or less, so it can offset the cost when you average um, so many companies put together. So, like, let's say add a portfolio of 10, for example, and then you only have one stock, for example, like this one, that's 350. I would expect the other 8 or 9 stocks to be, uh, less than like or around $100 or less. So, you would get an average, a little bit above $100. So again, the cost can be an option for people. For me, it's not really an option. It's just a matter of quality and the value for it. I think for me, I don't really say this too much, but the highest factor for me is the quality, and then we usually go from there. Growth sometimes usually follows, but it's hard to grow, especially in an environment like this, and after so many years where you're pretty much outnumbered by strong competition from years prior. So you really have to have an edge in a certain sector or certain type of business in order to gain an advantage, because market is ruthless and you just wind up getting bought out uh, as a company. And even if you have shares in a smaller company, you just hope that it doesn't get bought out. So we're gonna go through this thoroughly. I've actually heard of this company, SPGI. They're really good for a income portfolio. I like another one slightly better than this, but they're just as good. I just think they're a little too pricey, but with the price range, it's really really high. So it's more of a risk, is what I'm saying. But then also they can be a higher reward. So anyhow, looking at the first page, like I said, hold on, whoops, drop my pen for a second. So like I was saying, so the first page we have here, $114 billion company, as we can see here. I want to make sure my volume is all the way up. So 52-week high and low is 450 high, 278 low. That's definitely a really high range. That's close to, that's more than $100. Minimum of 150. So moving on from that, earnings per share is at close to 12. Dividend is at 3.4, where it's higher return payment, more than 90% of the companies out there. That I know for a fact. PE ratio is at 29.29 and close to 30, pretty much. Unusual number to have 29.29. So might have some growth, slight growth. Very, very active, as you can see. People like it. I think this, if I'm not mistaken, I think this company follows the S&P 500 as a index. The name in itself is pretty much self-explanatory, S&P, but this is S&P Global. I want to see if I can look at the top holdings for this company. It would be nice to see that. If not, then oh well. So distribution and order flow are people buying this stock. So this is what that order flow is telling me. Well, let me look at the chart first, because I'm jumping the gun. So with the 5-year, you can see here around 2018, had a little dip, then all the way to 2020. So it made gains from 200 pretty much all the way to close to 300. Dropped a little bit, close to 200 again, and then in 2020 just ripped from there. Then a slight drop, then went all the way up to close to 470, so around 465. Then starting to drop from there, starting to pick up some steam. Now it looks kind of flat, but for the most part, for the last year, it's gone down slightly. And then right here, I can say at least the last year, it's trying to, well, it tried to reach its high. So we have here in November and December, which was a crazy rally. That was like the Santa rally, as I like to call it. To be honest, I don't know how companies grew 30% in 2 months. Like I've been saying before, you have like these violent moves. Like it'll start going curling down, and all of a sudden in 2 months you have like a 40% move, which is like insane. So there needs to be more selling off in order to balance out this market, because there's just still too much buying in 2022. Those 2 months, that rally, that was just way too much buying. It should have ended up actually around here, maybe around not just for this stock is what I'm saying. It's just like overall, it should have came up to the halfway point of the low, but it actually got most of it back. So it almost jumped right back to its high from, that wave from this whole year, from the last wave. So we're talking about let me see, the high of August. actually, and that's usually a month that's a down month. So the high of August. So anyhow, moving on from that, we can see it definitely follows the S&P 500 just looking at the chart. And as of late, we have the 1 month trend. So it's trying to battle out this low for the past month, and then the past 3 months it still hasn't reached this low of 286. So it needs at least a $70 decline. I don't know the percentage for that, but like I said, at least a $70 decline from that. So for the chart, it's fighting its 200 EMA. So it's slightly above its uptrend. This nice little dip here, that would have been nice to enter right below that line, the 200 EMA. So we're looking at least a price of around 319 or less, and the lowest for that year was around 290. So even coming in at around 300 is still a good buy. So in my opinion, it's way overvalued. And according to the PE, obviously still overvalued. And then as far as growth, I don't know. That has to come from the earnings. A lot of people look at PEGs. I don't really look at that. I just follow the earnings because uh, the growth rate, I don't know. I just think that's a fake indicator because that's just speculation. You don't really know until everything's announced and you get the actual number. And that's why I look at earnings, because it's more accurate. Because whether they give you an inaccurate number, the number that you get is the actual number. So that's the number that you have to work with. So there's just no way around that. Once that number comes out, whether they beat earnings or miss, that's the number you got to work with for the whole year. And these growth rates, I don't even look at them, to be honest. That's why I look at the chart, because uh, prices go up and down. So yes, you might have a growth rate, let's say of like 8%, but then, you know, how far can that get you throughout the whole year? Because you might have that growth rate for 2 quarters, but then the next 2 quarters might be even lower than that. It might even take out the 8% with an environment that we are now. So, in reality, it's just some things just don't make sense, and that's something that just doesn't make sense to me. So, again, it's nice to speculate and forecast and stuff like that, but it's just unrealistic because of the environment that we're in. Again, I still believe we're in a downtrending market. So, moving on from that chart, the chart again didn't look too bad. Now I want to see some order flow for this stock. So to start off the year, it looks like there's more selling than buying, and these are the large orders. And if you look at these numbers, a lot of them are negative. And even if we were to add all these numbers up, so we have like 3, 4, 5, 6, 7, 8, 9, 10, and then a 1. So that's a negative 9 million. And then for medium sized orders, it looks like it's more than the outflow. So it looks like it's slightly more. Looks like it's slightly more, yeah, than selling. So who knows? It looks like even distribution of buying and selling. So it's gonna be a tough stock. So I think it's gonna stay flat for, I'd say, a few more weeks until there's further confirmation. But again, even with it going flat, it's still overvalued. Now for this stock, uh, we just want to see what is this stock good for. So quant ratings. So we have this stock. Highest rating that it has received is growth. Overall rating 2 out of 5. Income, I think, is slightly better than that. I disagree with that number. Momentum, this is questionable, but I don't think it's that low. Definitely not a 3.8. I think it's slightly higher than that, just because of the volume and that price range, and then the market cap alone. Definitely one of the higher popular stocks. And again, this is the main reason why this stock is considered favorable on Wall Street. This is just the main factor for them, because a lot of analysts rated this as a buy. So we have a strong buy at 29% and a buy at 71%. Either way, it's still a buy. So when you add that up, it equals 100%. So again, strong stock on Wall Street, and they like it. I like this stock for income portfolio, like I was saying. Definitely nice, and some capital appreciation. Definitely would be nice to a watch list. Now, other than that, if I wanted to use this for another strategy, if I wanted to use this for day trading, it's just too much money to day trade. Cheaper stocks are better, especially when you're putting $350 on the line. Might as well keep it for, capital appreciation for the long term. So as for growth, I don't know. It's hard to see a company grow like this. You can only grow so much. So as for growth, we want to see these numbers. Let's see what we have. You can see these estimates are going down. See, it's almost pretty flat from Q1, Q2, Q3. But for Q4, you can easily see that they lower those expectations. So we went from close to a $3 earnings per share estimate, going close to 2.4. I would say, I would guesstimate that. I would say, I don't know, 2.4. So that is actually close to like a 40-cent difference. That's pretty big. That's a big difference. So we're going to look at some more numbers. And again, when those earnings estimates come out, it's really going to play a part in the price range sooner or later. So returning on assets, we have at 21%. So that's a nice high number. ROE working in their favor at 68%. Earnings per share has grown. Obviously grew. I'm not surprised, growing year to year, last 5 years, especially in 2021. Margins have grown significantly. Stayed flat from 2018, 2019, 2020. Slightly grew 5% from 2020 to 2021. So there goes your growth rate. So around 5% for the year. So you're looking at a 1.25 growth rate for 2021. Debt to asset. So we have here their debts has been going lower, which is good. Again, I want to see more numbers for 2022. Hopefully that will come in soon. Hopefully by the end of this month. Net income has grown. Revenue stayed almost about the same from 2020. And then again, their debt has dropped. So again, a really good company so far. And then their cash flow. So that's really nice. So they definitely have enough cash flow, at least 2 billion in cash flow. And again, not including their net income. So we're looking at about at least 5 billion in income, or money that can be used that's sitting on the sidelines. This company does pay a raising dividend. Again, I said it before, it's nice for a income portfolio. So we have here from 2020, it grew its dividend from 67 cents all the way to 77. So that's a 10-cent raise. And that's quarter to quarter. So in total, a 40-cent raise, which is pretty damn good. And then from 2021, paying the 77 cents grew to 85 cents. So 8 cents raise for each quarter. So 8 cents times 4 quarters, looking at 32 cents. And that's still a nice number to grow their dividends. So 32 cents total. Dividend yield, again, I've said this before. The lower the dividend yield, the safer it is. I know it sucks to see numbers that low, and it's harder to accumulate the cash flow like that. Again, that's way too low. Again, I agree there's better stocks out there. But again, it wouldn't hurt to have this as one of your safer stocks for income and capital appreciation. So there you have it. So again, my analysis on this stock, again, I do like it for an income portfolio. So for income, I do like it for income. Quality, I'm not really sure. Value, I would disagree. Well, actually, I take that back. I would agree because I'm thinking the other way around. If the number was higher, that means the price would be cheaper. So value is actually price. Quality is basically, quality is just quality. You know, how good of a company is the company that you're buying and evaluating. Because again, evaluations change year to year. So for quality, I'm not sure about the number to give this a number. Income, I do agree with. Momentum, I don't know. It's hard to say. Overall rating, a 2 out of 5. I disagree with that. The value, I guess I agree with that. So really, it all comes down to the best way to use the stock. And again, too expensive, but it is good to add to a watch list for income. And again, I disagree with the overall rating, but I agree with a few other quant ratings that they have here. So again, I would say yes for an income portfolio. For growth, I'm unsure. For momentum, it does have liquidity, it does have high volume, but for momentum stock, I would say no. This is not really a growth stock. And then if you want to use it as a blend, for some growth and some capital appreciation, I guess sure, why not? A pretty large company at 114 billion, and again pretty active. And then you know, they have future outlooks to be raising their PE, so that's actually a good thing. So for growth, it's not a growth stock, but they do have slightly better expectations, which ain't bad. But I don't know if it's realistic. That's all. So again, that's my take on this company. So again, it is good for a watch list, again, but for a portfolio for income. So again, that's my take on it. Thank you guys for watching. I'm gonna review the next four. Sorry I'm taking long, but I'm just reviewing these companies for not only your enjoyment, for your understanding, and just for you to, see these stocks that are being reviewed and evaluated, so you can have a better idea for safer and better decision making in order to uh, provide feedback for you, so you can have a final decision as to adding to your watch list or personal portfolio. So thank you guys for watching, and I'll see you guys in the next one. I have 4 more to go.